I've been wanting to tell this story for a long time. My granddaughter was at our house a couple of weeks ago, and she was watching the Disney Channel. And one of the things they do is these little vignettes about kids that have done something really, really interesting and exciting. And there was a boy who I believe was maybe now about 15 years old, and he has climbed the 7 highest mountains in the world, okay, including Mount Everest. And he said something I didn't know. He said, most people probably assume that when you climb Mount Everest, you start at the bottom and you just keep climbing to the top. He said, no, that's not how you climb Mount Everest. You climb up to a certain level, you go back down, then you climb back up to that level. You acclimate yourself to the oxygen level. Then you go up to, from that point, you climb up a little bit higher, you come back down, you climb back up, you come back down. So it's not a straight line up. And so I thought, man, that is a great explanation of investing. That's how investing works. Stocks don't go straight up forever. You're going to have those little setbacks where you come back and then you go up again and you come back and you go up. But every time you go up a little bit higher. And as Aaron had that chart of the Dow Jones, and can you throw that baby back up, or did I scare you away from there? No. Okay. I hope that goes back a fair ways. I don't know how far that went. Was that a... Oh, yeah. See, this is my favorite chart in the whole world, and you can apply this to anything, okay? You can apply this chart to home prices. You compare this to consumer spending. Right here is 2009, the absolute bottom of the Great Recession. We had gone way up there to the left of that. Goes back to 2007. 2007, the stock market had hit an all-time high, October of 2007, around 14,400, something like that. Within 2 years, look at that thing, look at that crater there. Within 2 years, we had lost more than 50% of the market value, dropping down to 6,547. 6,547 right there on March 9th of 2009. I don't know what it was on that day that caused everything to change, but it did. And we then have since then participated in the greatest stock market rally that I've ever seen. But look at it. It is hardly a straight line up. There have been fits and starts, some of them rather big, others much smaller, but it's like climbing Mount Everest. You go up, you go back a little bit, then you go back up again. Higher highs is what investing is all about. That is a great chart, and charts can tell you anything you want. I'm not a big fan of charts, but I just like the visual that's involved here. The problem is, right there, the Wall Street Journal that day didn't have a headline that said, "Rally starts tomorrow." Okay? Okay? Nobody knew that. Nobody knew that. But if you were a long-term, committed investor, you'd been benefiting all the way down from October of 2007 to that bottom of 2009 because you were committed to the process, you were investing, and you kept investing at lower and lower prices, which is, Warren Buffett loves it when stocks that he owns go down, okay? Because then you get to buy more at a better price because he believes that they are long-term, all the companies he owns are great long-term investments. Listen, Warren Buffett's 83 years old and he considers himself a long-term investor, okay? That says an awful lot about the guy, Buffett said, I'm not worried about dying, it's going to happen, that nobody makes it out of this thing alive. He said, the only thing I want to know is where I'm going to die, and then I just won't go there. So that's a great explanation of where we were and where we are now. And again, a lot of that has to do with the fact that in 2009 we had seen the Federal Reserve drive interest rates down as low as they are and really take away a lot of the competition for the stock market. That wasn't why they drove down short-term interest rates to make the stock market look better. That's not the job of the Federal Reserve or Ben Bernanke or Janet Yellen or anybody else. But it's just a consequence of what they had to do to try to stimulate the economy. You bring interest rates down, it's in theory is designed to then cause more borrowing by businesses and individuals, and that gets the economy going. It hasn't really worked out all that well. That's why interest rates are still low. It's starting to finally work now, but it did remove a lot of competition from the stock market.